Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing Peter Boockvar again, who is the Chief Investment Officer of One Point BFG Wealth Partners. How are you doing today, Peter?
Hi, Daryl. Good to see you.
It was good to meet you in person in New Orleans. You know, oftentimes I'm interviewing people virtually, and it's always good to connect with people in person.
Yes, for sure. Yeah.
Yeah, so I want to start with your 2026 outlook. Obviously, there's a lot of things happening in the geopolitical sphere as well as the domestic sphere as well. And so just curious on your 2026 outlook, considering all of the things that's been going on.
On what specifically?
Let's on the markets. Let's say the S&P, the major indices, as they have been rolling over in gold terms, and I'm just curious. And what do you see in the future for those indices?
Well, the S&P, the question for that index in 2026 is where does the AI tech trade go from here, and does it power on, or does it falter? And if it falters, is it able to pass the baton on to other parts of the market, or does it drag everything down? I do believe it's beginning to have shaky legs. Now the baton has been passed. The market outside of Mag 7 are now beginning to outperform those stocks in the aggregate. So we are seeing some baton passing, which is good. But honing in on these AI tech stocks, a couple of things are raising my antenna. 2 quarters ago, when Oracle reported earnings and this massive $500 billion remaining performance obligation number, the stock spiked north of 300, and it's done nothing but go down ever since, when people realized about 60% of that was to one customer, that being OpenAI. And everyone now then questioning whether OpenAI, with all the money they need to spend, whether they would be able to satisfy all their obligations. Then that was followed up by the following quarter when Oracle stock got smacked again after numbers. NVIDIA had a great quarter, and this is in no particular order, this stream of things. Had a great quarter, the stock went up overnight, and then went right down afterwards. And then that was also exaggerated by the Google news about their TPUs, which compete against Google's GPUs, both for Google's business and other semiconductor business, reminding people that NVIDIA's dominance may not be as dominant just because the competition is intensifying. Then we had Broadcom reported a great quarter. The stock traded down after that. Meta had a phenomenal third quarter, but investors focused more on the huge amount of capital spending. And just to put sort of numbers behind the Oracle concern, Oracle in their last quarter raised their CapEx number to $50 billion for the current fiscal year. That's 75% of revenue, an extraordinary level of capital spending. So I think I put all these together, and it shows me that investors have now transitioned to looking at this trade as not one big winner. There are going to be now losers in addition to the winners. And that is, I think, a big step change on how investors are perceiving this group as an investment / a trade. So, but that usually is what happens when something new and exciting and sexy comes out. Everybody wants to own anything that touches it. And then you reach a point where people realize, yeah, not everyone can win. And there are going to be some losers and there are going to be winners. Let's try to find the winners. And I think that that's what's happening now in this trade. And also people are being reminded of how competitively intense it is and going to be from here, particularly from the Chinese, who are creating their own models, that U.S. companies are integrating themselves. They're creating their own tech stack. U.S. semiconductor companies are losing market share in China. So this is becoming a more, it's not a one-way ride anymore. And I think that's a big change. And we'll see whether, again, that disrupts the whole market or it's going to be isolated to those stocks. Now, in terms of the economic impact of all the data centers that are being built, that'll continue this year because projects are in motion or they're getting greenlit. Obviously, dependent on what kind of power they can source to make these things work. Therefore, we have to pay attention to the rate of change of all this spend. And we're going to get multiple years of data center construction, but if there's a rate of change slowdown in the pace of that, then that has economic implications as well. And if I'm right that this AI tech trade's faltering in terms of its dominance, if it does infect the whole market, well, then we have to pay attention to any potential negative impact if that were to happen, what impact that has on upper income spending, which has been benefiting from the wealth effect and has been a major source of economic strength.
Mm-hmm. Got it. Okay, so I'm curious in your perspective on this because I don't know if I'm just in a precious metals, gold and silver, commodities echo chamber, or if the AI trade is losing steam, because I just feel like I haven't really heard much about the AI companies. There was a lot of headlines, especially last year, all of these partnerships with OpenAI and data centers and partnerships with the government and such. And I have not heard a lot of that news lately. And so I'm curious.
No, let's differentiate. Yeah. The build out of this is not losing any steam.
Okay.
I'm talking about the stock market's performance.
Yeah.
Is losing steam in terms of its dominance. Mm-hmm. These stocks are becoming more splintered. Not everyone is going up. The market is even differentiating between the OpenAI ecosystem and the Google TPU Gemini ecosystem. Yeah. That's a big step change that it's beginning to differentiate there rather than just buying everything blindly. So that's what I'm referring to. The build-out's happening. All these relationships are happening. But maybe, again, on a rate of change basis, that's what we have to pay attention to. And maybe investors are shifting their focus to the beneficiaries of that spend, those that use AI in their businesses in terms of making themselves more efficient.
Mm-hmm. Gotcha. Okay, yeah, appreciate that clarification. So OpenAI, I mean, there was a lot of headlines about partnerships with OpenAI. I haven't looked into this, but are they even profitable? Like, I'm just curious.
You mean OpenAI?
Yeah.
No, they're losing many billions. But that's when you spend all as much money as they're spending, it's going to take a long time for them to get to any level of profitability. Their revenues are growing fast, their user base is growing fast, but they're many years off from profitability. That's not a focus of theirs right now. It's building out the infrastructure to improve their models is what they're mostly focused on right now, which would then, of course, help them gain subscribers.
Okay, got it. Thanks for sharing that. Okay, so there was a lot of talk about the AI being in a bubble. Multiple people have come out and say that. And you mentioned that some of this is losing steam and people are being more selective in which companies they're choosing. I'm just curious, are you thinking about a bubble with this particular sector of investing, or are you not really thinking that it's really relevant?
Well, the debate is the CapEx part of this Gen AI build out. That's where we can debate whether there's a bubble. AI is software at the end of the day, and software has been a progressing part of the world economy for generations. That will continue on. That's not a bubble. That's just technological progress. Mm-hmm. The question is the CapEx spend overdoing it as all these companies compete with each other to have a better model? That's the debate. The debate is, are we building too many data centers? And which I think is a legitimate debate. The history of technology is to improve the software and the power of it and shrink the size of the hardware. So the decisions to build a 4 million square foot facility today, maybe today that sounds great, and maybe all that space is needed to house all those servers and so forth. But maybe in a couple of years, the computing power can be strengthened with less space. I don't know the answer, but I think it's a legitimate question. And I think those are the questions that people are now beginning to ask.
Yeah, for sure. Okay, so what's your view on obviously the Fed makes decisions as they come, and recent news, with the Federal Reserve being under investigation and such, there's speculation that Trump just wants to lower rates and such. And so I'm just curious in how you're framing that into, it's recent news. So people are probably just kind of going, I don't know if they're going back to the drawing board and like, okay, let's reassess this or whatnot, but just curious in how you're processing that.
It does add to the drama, and I think will accelerate the outperformance of international markets relative to the U.S., will put pressure on the U.S. dollar. And I think that's why on the day we're taping this, gold is up $100 and silver was up $5 or $6. So I think, now, I don't think that Jay Powell, and it was specific to Jay Powell, not necessarily the Fed and him getting accused of perjury to Congress. I don't know exactly what they were referring to in his testimony. I'll have to read about it, but I doubt anything comes of this. But the point being that to go to this great extent to try to manipulate monetary policies is quite extraordinary, even though it's been done in the past. Trump's not the first one that has tried to bully the Fed. This is not new. It goes back many presidents and many previous Fed members. It's just the extent of how it's gone. But putting that aside, obviously the stock market was unperturbed. It opened down and closed at the highs of the day, and so that has not been bothered. Because I think the stock market doesn't believe anything comes of this, and there won't necessarily be any economic consequences, because regardless of what happens with it, Jay Powell is gone in May anyway. He's only got 3 meetings left. So Trump can have all the rate cuts he wants after Powell leaves, which is not too far off.
Okay, got it. And so as far as the international markets, emerging markets, obviously if there's pressure on the dollar, weaker dollar, lower rates, let's say the Fed starts quantitative easing, whatever the case may be, is this a sector that you all are looking at bleakly in terms of investment opportunities?
I'm sorry, which sector?
The emerging markets, international markets.
Okay. Yeah. So I'm very bullish on international. I'm very bullish on emerging markets, both debt and equity. And luckily, we were bullish a year ago from now because they had a really good year last year for the first time after many years of underperformance. And the pendulum just swung so far in one direction in favor of the U.S. market relative to global GDP, global market cap, that we were due for a swing back in the other direction. And clearly that happened last year. And I do think it's more than just a one-year phenomenon. If I'm right that the dollar is going to resume its downward trend this year, then I think that would help those international investments. I think what's going on in Venezuela is very interesting for Latin America. You look at Chile, you look at Argentina, potentially in Venezuela, and we'll see in October in Brazil a shift to the right politically, which I think would be very good for their currencies, for their economies. And so we own some local currency emerging market bonds at the sovereign level that currently benefit from a really generous yield. Central banks there have kept real interest rates very much positive. And there's a lot of room for central banks to cut if inflation remains pretty low relative to where interest rates currently are. Then if you get the strength in their currencies relative to the dollar, that can be an extra kicker for that trade. And we also like, particularly we're bullish on Brazilian stocks, and we own some stocks there as a play on that as well. But I'm also very bullish on emerging Asia. And in addition to China and India and other parts of that region, as economic growth relative to the rest of the world is pretty good there. So, and even in Europe, we're finding some stocks that we own that are domiciled there that I think are pretty inexpensive, pay nice dividend yields. And so I still think that there are plenty of good opportunities that the market's finally woken themselves up to, and realizing that they're not just 7 stocks out there. There's a whole world of stocks, and that's a good thing for stock pickers.
George and his team, a 16-year VRIC employee building some of their largest mining operations on the planet. We started a drill campaign, from the drill campaign moving into a full engineering report and study. We came out with our pre-feasibility study in 2021, and it showed a really impressive economic case for advancing the project. We'll have final definitive feasibility out in December of this year. So in the space of 4 years, fully engineered, fully permitted. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
I believe when you came on last time, I think we may have talked about oil. And so just curious in your perspective there. Obviously, there's multiple narratives, oil glut versus, the cost of production it's lower than what the current oil price is per barrel. And obviously, time horizons matter too, and maybe there is like an oversupply in the near term. But if some folks are modeling out longer term, then they may see more opportunity there. And so, just curious, what's your perspective on oil?
Well, if you look at and you count all the oil tankers that are on the water, you can say, yeah, there's a lot of oil out there that's not being consumed. But if you expand out and you look at global inventories in totality, I don't think that there's much of a glut. If you look in the U.S., you look at inventories in Cushing, Oklahoma, and they're near 10-year lows. So it depends on where you look. So I don't see this glut that many people are talking about. I admit that probably there's a little bit of excess supply, but I think demand for oil is still pretty strong, north of 1 million barrels a day. I think, yes, we have to focus on what's happening in Iran and Venezuela for possible production increases in the coming years, but I think that that's years out. I think on the flip side, the U.S., which is the biggest oil producer in the world, they're seeing a plateauing of production in the shale basins, and that has been the largest area of non-OPEC plus supply over the past 15 years, when U.S. oil production went from 5 million barrels about to almost 14. Sentiment is very down when it comes to oil. Goldman Sachs just came out with a sentiment gauge of their clients, and there's the highest level of bearishness in more than 10 years, just below where it was in April 2025. So from a contrarian standpoint, I like seeing that. If you look at the weekly CFTC data, the net speculative long position in crude oil futures is just off 15-year lows. Another good contrarian sentiment setup. Price-wise, I don't think the Saudis want much lower oil prices from here, and a main reason why they held their quota increases unchanged in Q1. I think even with the quota increases, actual production didn't rise as much as the quotas, which tells me that maybe there's not as much spare capacity out there, and it seems to be only in Saudi Arabia and the UAE. Look at U.S. shale, getting back to that. Most of them lose money with oil much below $50. So I think putting this all together on a risk-adjusted, risk-reward basis, oil at $60 is pretty compelling. The oil and gas energy sector is only 2.9% of the S&P 500, which maybe once it's been that low, going back many decades. U.S. oil rig count, 4.5-year lows. And you can be sure if oil breaks below $55 to the downside, that number is going to shrink even more. So I'm very bullish on energy. And if the industrial metals, precious metals bull market starts to widen out to other commodities, I think oil is going to be potentially a key beneficiary. So we're long a few oil and gas stocks. And I think agriculture has been missing out on this commodity bull market as well. With the depressed prices in corn and soybeans and wheat. And we'll see if that gets going. And we're long a couple fertilizer stocks if it does.
Mm-hmm. Okay, got it. So what did you take of the meeting that Trump held at the White House with the big oil companies? I believe Darren Woods, CEO of Exxon, said that Venezuela is uninvestable. And there's a lot of talk about the type of oil Venezuela has and refining capabilities, and a lot of the technology and infrastructure there is outdated and such. And so just curious if you're looking into that as well.
Well, he said it's uninvestable in the context of the current political situation. No one's going to put a dime in there until we know who the leader is and where politics go from here and what the economics go and what the security situation is. There's so many boxes that need to be checked before anybody notably increases investments in the country. So I think that's what he was referring to. I mean, there are oil riches to be had there. So I think anybody who has the opportunity is going to want to invest there. But he was really referring to the current situation today, where a lot of questions need to be answered and clarified. But yes, it will take a lot of money and a lot of time to get Venezuelan oil production back to a growth pattern relative to the 3 million they were producing before Hugo Chavez, or even soon after he came in. It's going to take, I mean, I've seen everywhere from 5 to 10 years. And that's up from, 800, probably closer to 900,000 barrels that I've seen today. But oil demand grows 1 million to 1.5 million barrels a day anyway. So we'll grow right into that supply. So I don't think it's really going to matter right now for the price of oil, and it doesn't affect my bullishness on the stocks there.
Okay, got it. Thank you. Okay, so gold and silver, the precious metals. I believe last time we talked, silver may have been at, I don't know, $50, $60 or something of that nature. Curious in your outlook there.
So yeah, it's been a great ride. We've actually trimmed a little bit into this rally just because of the vertical nature of the stock charts. Fundamentally, still very bullish. I think the criminal targeting of Jay Powell highlights the importance of owning gold. And to my point earlier about international investors who clearly rethought their allocations to U.S. markets and their interest in diversifying. And I think that gold is right now probably the most important reserve asset in the world. And I think it's going to continue to grow in importance. Silver has gone parabolic here. I have to acknowledge that, even though I think we just finished year 5 or in year 5 of supply-demand deficits, as industrial use still remains pretty solid. Even though on the industrial side, sort of data center build-out, there was actually a reduction in demand for silver just because of the manufacturing slowdown. It's really been ETF buying that has created the deficit. But regardless, there is a supply-demand deficit with silver that can probably keep a floor under the price, and we'll probably see more upside. But again, we've ridden this for many years, and we just trimmed around the edges here.
Okay. Do you think...
in addition to platinum, too, which we've been long. Okay.
Yeah, appreciate that. Do you think the stocks have a long way to go? I mean, obviously the GDX and such, they were performing well, even the ETFs for silver. But when you look down the chain at some of the junior miners and such, some of them have done well, but then some of them, it doesn't seem like we got that euphoria yet, but I'm not sure. I'm just curious in your perspective on that.
I agree. We have not. I think also when you look at ETF flows into the big, GDX and GDXJ, they're well below their highs. So I agree. There's more upside, and we've not gotten anywhere close to the euphoria phase for the miners.
Okay. All right. Got it. Okay. So looking at silver, I mean, silver's obviously went parabolic, and you have folks calling for triple-digit silver. You and I talked about silver's inflation-adjusted highs. I mean, we're about, $15 from $100. Do you think this trend continues, or are you expecting it to cool off at some point? I mean, it seems like it just won't stop, even if it's the paper contracts or whatnot that get or the shorting that gets the price down a little bit. It's like a beach ball in the water, just goes right back up, and so.
200 is the inflation-adjusted high of 1980. Now, I don't know whether it goes there or not. I'll probably be out of silver well before it goes there. But that's context, at least, for where it could go, just to get back to its 1980 parabolic peak that was retested in 2011. Just context, and also it's good to also price it relative to gold, and we'll see whether these current high prices can elicit more supply. The issue on the supply side is there aren't many pure silver mines, as you know. It's mostly a byproduct of copper and gold mining, and so you can't just dig more out of the ground because you want to and snap a finger and get it. It takes a lot to add more supply to the market, which I think will support prices too going forward. Okay,
got it. Any other sectors? So we covered commodities, from oil to agriculture to the metals. We covered AI, tech stocks. Just curious if in international markets, just curious if there are any other sectors that you are bullish on or you're thinking look attractive right now.
The other sector I like, and sorry to disappoint people on the excitement scale, but it's probably last year one of the worst performing groups outside of energy, and that's the consumer staples sector, both consumer products and also food. This sector has been hammered. I think they're cheap. I think they pay great dividends. And I think a lot of these companies are trying to adjust to the new world of a very sensitive lower to middle income consumer. And I think there's a global set of opportunities, particularly in emerging markets, for a lot of them. And so we're long a bunch of food and consumer non-durable stocks that I think are highly attractive right now in today's environment. And if the economy does run into some trouble, then I own stocks in a very defensive, cyclical sort of place in the markets that should do much better than other parts of the market.
Okay. Yeah, thanks for that. Okay, so last question. What are some of the questions you're getting nowadays from, you interact with quite a few people. Obviously you have investors that you connect with. You have, an audience that you speak to and such. What are some of the common questions that Peter's getting today? And any thoughts to any of those questions?
Well, there's no question that with the stock market at record highs, people are impressed by the resilience. We are now on the cusp of getting fourth quarter earnings reports. So that resilience, of course, will be tested as we hear from corporate America and companies around the world, which will be really interesting. I've been very much focused on long-term interest rates and long-term sovereign bonds because at least in Europe and the US, they're not responding to cuts in short-term interest rates. They're remaining very elevated, which I think is noteworthy. And then we have in Japan, the BOJ that's raising interest rates and long-term interest rates continue to rise there. That's a big focus of mine because people ask, okay, the Fed's cutting interest rates, and is that going to help my mortgage? It helped me buy a house and lower the mortgage. Mortgage rates have fallen a bit, but the 10-year yield is stubbornly above 4%. So to me, that's a focus that not many people are seemingly focused on, strangely. But I do think if the rise in long rates continues, they will at some point pay attention. And then, everyone's trying to figure out, what's the next tweet, what group is going to be affected. But that's, that's the current investing environment we're in, and we're all trying to figure it out.
Mm-hmm. Do you think Trump's plan to buy $200 billion of mortgage-backed securities, do you think that's going to make any type of impact in the long end of the mortgage rates or whatnot?
At the end of the day, the mortgage rate is going to go where the 10-year yield goes, and the 10-year yield is still the same as it was the day before they announced that. What they're trying to do is close the spread between mortgage rates and the U.S. 10-year Treasury. Will $200 billion be enough? I don't know, because there's also hedging that goes on in place to buyers of the Fannie and Freddie need to hedge those purchases by shorting Treasury. So I'm not sure if it's going to matter. I think the housing market needs more supply. Doesn't need more demand, in the sense that the experience over the past 25 years with housing policy in the United States is it's been pedaled to the metal on the demand side via the Fed and Fannie and Freddie without a coincident increase in supply. And when that happens, you get a sharp rise in home prices. which completely offsets any benefit that you get from lower mortgage rates. So if this time around we don't get a further increase in supply and all we do is push demand, the same thing's going to happen. You're going to see a rise in home prices, which is great for those that own, but is going to completely offset the benefit of lower mortgage rates for that first-time buyer that doesn't own a home and does not benefit from higher home prices, and in fact gets hurt by it because they can't afford it.
Okay, got it. So it could backfire. Okay, well, appreciate you for coming on the show, Peter. Where can people connect with you? I mean, you're on X, you have a Substack. Obviously, you're at One Point. And so just curious where people can connect with you, plug the audience.
Well, with One Point, you can go to our website, onepointbfg.com, and learn more about our wealth management firm and services. And on Substack, my report's called the Book Report, and I write daily on the markets and the macro stuff out there, and a lot of economic stuff. And people can try it out, and if they like it, they can subscribe.
Okay, sounds good. Well, you all have that information. Please hit the subscribe button if you haven't subscribed yet, and click the link that's pinned in the comments to the Vancouver Resource Investment Conference. Love to see you there. It would also be live streamed if you're unable to make it in person. All right, thank you, Peter, for coming on the show.
Thanks, Daryl. Appreciate having me.